Hey everybody, it's Pete. Good morning. It's Wednesday, July 15th, 2020. Welcome to today's episode of Stocks for Breakfast. And before we get started, I just want to answer a question that somebody brought up yesterday about the boot camp. They actually emailed me and they wanted to know if they actually get to see the trading opportunities that I call out and the trades that I make. And yeah, 100%. That's kind of actually the whole point. The way the boot camp works over the 30 days is you get access to my complete order flow masterclass. But then even more importantly, we're live in the market with each other all day. And we actually have a whole separate channel where I call out the trade ideas. And then even on top of that, we review everything in our weekly live coaching call every Monday night. So it is a common question for some reason. So yes, you actually do get to see my trades. Today, we're going to cover moving averages. It's interesting because I'm known for tape reading, which is really just getting into the nitty gritty of reading the actual candlesticks themselves and building that argument for a trade. I'm asked why I don't use moving averages, why you don't see them on my chart. I actually do use them, but I just want to make the distinction. They're not my primary driver for making a trading idea. They're not my primary decision-making tool. I know it's very easy to use them, and I actually suggest that you kind of start out with them while you're still learning to read the tape, while you're learning to build better arguments for trades, because it does kind of give you the simplistic way or the easiest way or the quickest way to determine is a stock long or short. Long means you want to be a buyer, short means maybe selling it. But once you get a feel for actually reading the tape, once you get a feel for reading the order flow, you'll see why I don't use them. And I'll point it out in a second because especially when you first start trading, you tend to say, well, it's above the moving average. And that's not enough. You need to build an argument for a trade that says it's above the moving average and the moving average is rising. Big difference, right? Then you can get into some subjective stuff about how far away from it is from the moving average and that kind of stuff. But the single biggest thing that you miss when you're just using moving averages, and it's more of a tendency, not an absolute. Maybe this doesn't fit you, but what ends up happening is you kind of miss what's actually going on in the price action. You miss, is the stock actually stuck in a range and there's absolutely nothing to do? Has the stock gone parabolic and is it not a good trade now, but it is a good idea? Looking for a different entry, and we kind of just say whether it's above or below and leave the decisions to that. It's not really black and white like that. Again, everything that I do, everything we teach at Stock Trading Pro is about building an argument for a great idea. We talk about risk reward is what you're looking for, but really the question is, what are the odds? What are the probabilities of your reward being hit? And all of these questions that we teach you to ask go into that. It's great that you have a stop loss, and it's great where you'd like the stock to go, but what are the odds of actually making money? And it's kind of like real estate, I guess you would say, where you have a choice where you could buy a really, really good house at a discount, and the odds of that being a good deal for you are pretty good, or you could buy a house that's really nice in the worst neighborhood and probably not a good deal for you. And if you can really understand the distinction between those two, that means that all trades are not the same. That's a huge, huge thing, a huge light bulb moment that goes off when we start working with people. And we actually had a really nice moment in our trading room yesterday where somebody mentioned, I don't see anything. I believe it was Gary. And somebody else, I believe it was Sari actually, commented in the room that Pete will be happy about that. And it sounds weird that I'd be happy about him not seeing anything, but what that really means, and think about this, is that really means that he's really starting to understand the edge, because sometimes there is nothing to do. When you actually have structure, when you learn to build an argument, when you know exactly what you're looking for, you'll now know this is what my A plus trade looks like, and everything that moves away from A plus starts to get to that point. We should have much lower conviction and probably not even be trading at all, which we kind of had that quite a bit yesterday on the day trading side of the business, where a lot of stocks had lighter volume, opened lower. We did call yesterday's lower opening, and quite a few stocks bounced. But then in the afternoon, just kind of drifted sideways on lighter volume, which is where that comment came from. I don't see anything, which is just a phenomenal spot for a trader to get, where number one, you understand what you're looking at. You understand if you have an edge. And number two is you're actually okay with doing nothing, because you realize the better trades are when the edge is there. And those are the ones where the probability of profit are super strong. So we're going to get into moving averages right now. We're going to talk about the different ones. We're going to talk about how to use them. And if you could please do me a favor, if you find these videos helpful, please click down and subscribe. That would mean the world to me. Plus, you'll get updates. And if you'd like to learn more about the boot camp and trading together in real time for 30 days, click the link down in the description and click through and see how other traders are doing. I think you'll be pretty happy to take the next step. So we're going to share the screen. We're going to hop on over. And we're going to start out with looking at the market. And what's interesting here is we're going to take a look at the difference between the S&P 500, the SPY ETF, and the NASDAQ. And just this one little simple thing that we're going to cover right now will show a stark difference in which stocks you should be trading, which again kind of stacks that argument or begins the argument of how to make money and how to make money on a regular basis, which is being in the right stocks. And then the last part is being in those stocks at the right time, because you can pick the right stock, get in at the wrong time, the stock pulls back on you for 3 to 5 days, you take a stop loss, and the stock does everything that you expected it to do, and that's a timing issue. So finding the right ideas and finding the timing, not the same thing. So what we're going to discuss, we use all of the common moving averages because basically they become self-fulfilling prophecies if everybody's looking at them at the same time. The thing I do want to point out, which I'm pretty... and this is based on a lot of experience and data and real trading and whatnot. I use simple moving averages. If you really think about it, a moving average is the average. and we use the 20, the 50, and the 200. There's exponential moving averages and all these other kinds of moving averages. An average is literally an average. Why would I want to mess with an average? You have the price action and you have the average. So I use simple moving averages. I don't use exponential. I've experimented with exponential in the past where it weights the most recent price action heavier and moves quicker. But you know what? You have price. Why would you alter the moving average when you could just look at the candlestick or the bar chart itself in addition to the moving averages? So that's my argument. You might find simple and exponential, mix the two of them. Absolutely nothing wrong with it. That's how I do it, though. So right order is what matters. So the right order, meaning that if you want to be a buyer, the faster moving averages should be above the slower moving averages. So in this case here, the 20 should be above the 50 and the 50 should be above the 200. That's what's technically known as the right moving averages. So you can see here, this is the 20, and just recently it started to rise. So this period here where there was much easier money to be made, where it was, let's say, buying opportunities were much more profitable quicker. Right now, you really got to get in there and work for it, which, by the way, is a very big lesson in trading. The better job you do at trading better opportunities, you have a lot less stress and the trades move quicker for you. Then we have the 50-period moving average, which is also rising. But interestingly, just now, it's actually started to catch up and get above the 200. So this, from here to here, the 50-period moving average was actually below the 200, which is not the ideal scenario. So think about that. We had some opportunities which were momentum trades on a little bit slower time, longer time frame over this period of weeks. But the longer time frame, the shorter time frame, and then the little bit longer time frame. Just now, the 50 is moving. So just now in the S&P 500 in the SPY ETF, we are now seeing all three moving averages in the right order. But again, here's the key where a lot of traders make mistakes. The 200-period moving average is flat as a board. There's no edge. The thing with moving averages are that it's one thing for the price to be above it or below it. Let's just stick to above it. A rising moving average matters because that means over time, the price history, the order flow is actually moving in that direction, which, by the way, that's another big distinction I want to make between tape reading and chart reading. Chart reading, nothing wrong with moving averages. And when you think of moving averages, the terminology you use is trend. What's not really taught enough, what you'll normally not find in books, the reason I use the terminology order flow is I want you to get out of the mindset of I'm just following the trend. But the trend of what? That's why we use the word order flow. Order flow is the actual large orders. It's the flow of orders from the smart money, the flow of orders from hedge funds and banks and institutions. They call the floor. They send the orders to their broker or whatever it happens to be. And obviously, the floor is a lot less active than it used to be. That's what the order flow means. So if you were a broker or a specialist on the floor of the exchange, you got the order flow. You were placing orders on behalf of your clients. They gave you the order flow, and the better job you did at getting them better fills, the more order flow. They give you 500,000, a million, 2 million, 5 million shares to work. And the better you work those orders, that was the order flow, the more business you got and the more commissions you made as a specialist or a floor broker. Chart reading, technical analysis using moving averages, it doesn't really have you in that mindset of looking at the chart and saying, okay, can I clearly see somebody's in charge of this stock? Is order flow consistent in this stock? And should I be buying or selling it? If the answer comes back no, you pull yourself back, which again, that's kind of why I don't use moving averages as my primary indicator, because you could look here and say, oh yeah, it's absolutely going up. But if we remove the moving averages and you just look at the price action here, the SPY itself has actually been in a trading range for the better part of a month. So the SPY, especially if you've been trading the futures, the E-mini S&P futures, you've probably been very frustrated the last month because we're not really seeing consistency from day to day. Now, what's interesting is we're up today because of some overnight news about a possible vaccine for the pandemic. So it wouldn't shock you that we finally get out of this range and we're starting to see some follow through. So we want to compare very quickly. Again, just one thing I want to point out here, and then I'm going to go very quickly to take a look and see what these moving averages represent and how to trade with them. So the 20-period moving average, which is considered the faster one for most people, that's generally what people call the momentum moving average. So prices above that, you could generally, and rising, both price rising and the moving average, those are more shorter term trades, the shorter term price action. That's what's going on right now. The 50-period moving average is usually used a little bit more for swing trading, where it's a little bit long in a little bit longer time frame, trend of orders, trend of prices. And if you know Dow theory says that's the intermediate trend, which is where most swing trading happens, where you're looking to catch the next wave on daily charts, not necessarily looking to day trade. However, when you combine the two of them, and where they're both in the right order, meaning to be a buyer, the 20 is above the 50 and the 50 is rising, which you can see here was the fastest move period, that's when you start to stack the odds, right? And even better than that is what many people consider the line in the sand for a longer term bullish and bearish market, which is the 200-period moving average. Not really used as active traders unless you're pulling back and holding it as support or crossing it into new territory where the 50 actually crosses to the other side, which we actually saw here. So prices here penetrated and then the 50 crossed over. This is a big deal. This is when the 50 crosses to one side or the other. That's generally speaking a pretty big deal. So it's going to be super interesting to see what happens here, because the 50 now has just recently crossed above and should not be a shock to technical traders that the moving average is crossed, and now we're starting to see some more buying. So essentially what's happening is this buying has now sustained itself to get all the way back above here in a crossover. I'm not saying we're definitely going higher. This is where, this is the difference between chart reading and tape reading. Tape reading is you start to put the pieces together. We still need to clear some recent levels. We still need to have room to go. We still need to see volume coming in, because if we add volume as the last piece, you'll see that for the most part recently on the selling days, volume has been significantly higher. Now, we did have a little bit of volume yesterday, so that could be a good thing. We'll see. But what do we need to see today, which is, again, trading versus tape reading versus chart reading. So now we take it to the third degree, which is I want to be a trader and make money from the market by learning to put these pieces together. What do we need to see today by going deeper than just the moving averages? We need to see the stock and the market to go well bid today, which means we need to see higher highs, higher lows above yesterday's close, and specifically above today's open, and closing near today's highs to have a little bit more conviction in our share size and how long we hold the trades. If that ends up happening, one good trading day when everything lines up could make your month. But again, you need to put these pieces together. That's the whole point. So what I want to point out here is this area here, which is when prices are between the 20-period moving average and the 50-period moving average. That is one of the most challenging aspects of trading, because you're technically still in an uptrend, but now you've pulled below momentum and you're looking to hold a little bit longer term. I call that the phantom zone. So if you happen to be trading and that starts to happen in your stocks, when stocks go into this phantom zone here between the 20 and the 50, it reduces the probability of follow through, and you want to start to work your orders a little bit different, a little bit piecing it into a trade until this happens where prices get back above the 20. So the last thing I want to cover here, which is very important, is being able like that to determine whether or not opportunities are obvious and you can expect follow through. So we're clearly looking at the SPY ETF here, and you can see the 200-period moving average flat. You can see the 20 cross the 50 here, which gave us some good opportunities here. And it took all the way till now, just recent price action for the 50 to cross up, where all of the moving averages are in the right order. So we're going to talk about the NASDAQ, which has been carrying most of the market and just really, really on a tear. A lot of these stocks are making new all-time highs, and they're calling it this. A lot of them are stay-at-home stocks where they're benefiting from the fact that we're all cooped up and quarantined right now. And you can see that NASDAQ was in the right order much, much sooner than the larger, broader market, the S&P 500. And these were the better opportunities. And we saw that in a lot of stocks. Just pull one up, for example, DocuSign. You can see how strong the stock has been. So it's kind of interesting to see the really, really obvious and how that affects price action and your trading decisions and how you manage the trade, because you can see the stock was never in the phantom zone here. And this is actually kind of a really good example. As long as it stays out of that phantom zone and you're a buyer and you're long, it becomes much, much easier to not get caught up in one candlestick pulling back. And now you know exactly what to look for if and when that pulls back. But the next step is actually understanding when to book profits and how to time your entries. And again, that's the next level. And that's what we cover a lot in the boot camp, which is really getting into, okay, I want to be a buyer. Everything's lined up, but how do I make money? And that really is the difference between being a chart reader, a tape reader, and really elevating yourself to being a trader. Is when you really start to fine-tune your trade management, when you really start to buy at the right time, when you set the right profit targets, where if you set a target and it hits the target and you get out because that was the right trade, or maybe you move up a trailing stop loss, a profitable trailing stop loss, you did it at the right time because you understand how to read the tape and understand how to set those targets based on price action. So the moving averages are good. They're a quick and dirty way to tell you which side of the market to be on. They're a quick and dirty way to tell you we're in that phantom zone. I got to pull back my conviction level a little bit. That means I have to work the order a little bit. And then the next level is really understanding how to make money, because I did it for a long time. There's a difference between understanding how to read charts, moving averages, and chart patterns from actually getting paid. So I hope that helped. I hope that gave you a little bit of structure for exactly what to do. And if you have any questions, definitely leave some questions below the video. Leave some feedback if there's something else you'd like for us to cover. And absolutely give us a thumbs up and, subscribe to the channel, because I think you'll really get benefit from when we get updates and more educational stuff like this. And if you want to take it to the next step, absolutely click down and learn more about the bootcamp. I'd love to see you in the community. Have a great day, everybody.